For like forever, value investing was the gold standard. You know the drill. Buy cheap stocks, sell them when they're not so cheap, and you make money. Simple. But over the last 10 years or so, something has gone completely, fundamentally wrong. So today we're putting on our detective hats to solve the mystery of value investing's lost decade.
I mean, just listen to the despair in that quote. That's from a top value fund manager basically telling investors, yeah, everything we thought we knew just isn't working. Another manager said the market was telling them they were wrong about almost everything. You have to ask, why? What happened?
Okay, so this chart right here, this is basically our crime scene. The red bars show the returns from a classic value strategy. And look, back in the 70s, the 80s, it was a money-making machine. But then look what happens right after 2007. It just flatlines and then goes negative. The trail has gone completely cold.
And that leads us to the central question of this whole investigation. What killed value investing? Was it one single event? Was it some kind of slow-acting poison? Or has the entire economic game just changed right under our noses? Let's follow the clues.
All right, our first line of inquiry takes us to a potential flaw in how we even measure value. It's possible the tools everyone's been using are just, well, they're just old and busted for today's economy.
So the number one tool for any value detective is this thing called the market-to-book ratio. It's actually pretty simple. You take what the market says a company is worth, its market cap, and you compare it to the value of all its stuff on the balance sheet. That's its book value. If the ratio is low, hey, you might have a bargain on your hands. But what if that book value is just plain wrong? And this slide, this is a huge clue. It shows a massive shift in our economy. That orange line is companies investing in tangible stuff, factories, machines, things you can touch. The blue line, that's investment in intangibles, things like R&D, software, branding. And right around the late 90s, the lines cross. Intangibles completely take over.
Here's the thing. Our accounting rules were basically written for a world of factories. When a company builds a factory, it's treated as an asset. But when a company invests billions in, say, research or building a brand, those old rules say, nope, that's just an expense for this year. This just crushes the book value of innovative companies, and it makes them look ridiculously overvalued to a value investor.
And boom. This is our aha moment. The red bars are the old, broken strategy. The blue bars? That's what happens when you fix the accounting for all those intangible investments. Just look at the 80s, 90s, and early 2000s. The returns are way, way better. So we found a major flaw. But, and this is a big but, look at what happens after 2007. Even our new and improved strategy struggles. Suspect number one is definitely guilty of something, but it looks like they had an accomplice.
So, okay, fixing the accounting clearly helps, but it doesn't solve the case of the last 10 years. This tells us we have to dig deeper, to look for a much more fundamental change in how the whole economy works.
And this is where the mystery really gets interesting. If fixing that huge accounting flaw isn't enough, what on earth happened around 2007 that was powerful enough to break not just the old model, but the corrected one too?
And here, ladies and gentlemen, is our prime suspect, a phenomenon called the Great Mean Reversion Slowdown. Now, I know, it sounds super technical, but the idea behind it is actually pretty straightforward, and it's literally the engine that makes value investing run.
Think of mean reversion as the natural churn of the market. Today's high-flying, super popular glamour stocks, they eventually hit a rough patch. And today's beaten-down, forgotten value stocks, they often find a way to recover. Value investors make their money betting on this constant reshuffling. But what if that engine just stopped? Okay. This chart is our first piece of hard evidence. It shows something called rank correlation. Don't worry about the jargon. Just think of it as a measure of stickiness. And you can see that in the period from 2007 to 2018, that bar is the highest it's ever been. What this means is that if a company was a value stock last year, it's way more likely to still be a value stock this year. The reshuffling just isn't happening.
And here's what that stickiness actually means in the real world. The average number of years a company stays stuck down in that value category has jumped from about 2.5 years to well over 3 years since 2007. They're just not climbing out of the bargain bin like they used to. So the conclusion here is pretty clear and pretty stark. The engine of mean reversion has seized up. The winners just keep on winning, and the losers just keep on losing. And this lack of movement completely starves the value strategy of the opportunities it needs to make money.
So why? Why do the engines stall? Well, it seems that ever since the financial crisis, we've been living in two totally different economic worlds. On one side, you have the value firms. They're often trapped in old industries, they're starved for cash, and they just can't invest to innovate their way out.
On the other side, you have the glamour firms. They dominate the new, intangible economy. They're flush with cash, protected by patents and network effects, and their profits are soaring.
And the data, man, it just screams this story. On the left, you can see profitability for the big value firms has totally collapsed, hitting its lowest point in 50 years. Meanwhile, on the right, the glamour firms are at an all-time high. It's a total, complete divergence. They're on two different planets.
And here's the trap in action. This chart shows retained earnings for value firms. That's the money they have left over after paying dividends. And since 2007, on average, it's been negative. They are literally bleeding cash. And if you don't have money, you can't invest in the R&D and the tech you need to climb out of the value trap.
So our investigation has turned up two main culprits: outdated accounting and a stalled economic engine. The verdict is in. But what does this all mean for the future? Is value investing dead for good?
Well, the research actually gives us a sort of playbook for how a company can escape the value trap. The ones that managed to break out did a few key things. They invested heavily in intangibles, they grew their sales, they used debt to fuel that growth, and, this is crucial, they avoided losing money. It's all about internal investment and innovation, not just sitting around waiting for the market to change its mind about you.
Now, a lot of people hope for a big comeback. They'll say, value stocks are just so cheap they have to bounce back. But this chart here, it kind of throws some cold water on that idea. It shows the valuation gap between glamour and value stocks. And you'll notice that where we are now, it isn't at some crazy historic bubble-like extreme. That suggests that just being cheap might not be enough to kickstart a recovery this time.
So this is the new reality we have to face. The big firms at the top are more dominant and more protected than ever. The firms at the bottom are stuck and financially trapped. That cycle of creative destruction that used to power the economy and the value strategy has gotten a lot weaker. Finding a true diamond in the rough is just harder than it's ever been.
And all of this leaves us with one final and really critical question. The world has changed. The way companies invest, the way they compete, the very flow of money through the economy, it's all different. So maybe the conclusion here isn't that value investing is dead. Maybe it's that our old, dusty definition of what value even is completely obsolete.